Let me get back to business and get the next panel up. We have this is an interesting panel. This is about family offices. You know, we've done a lot of angel investing conversations, etc. But let's look at early stage participation and support by family offices. And the topic that we are discussing is family offices, investing considerations and product landscape. So what are the considerations they have? What's the landscape, etc. There are two areas that I would love for this panel to delve a little deeper into. One is redefining family office strategies. You know, we know that the ecosystem is evolving. We've also seen the up and coming, nature of family offices by themselves as pretty serious investors. Lots of them are getting formalized. Lots of them are really, been there for a while, and they are rethinking and redefining themselves. So, we'll look forward to hear on that. And the next topic that I would love them to touch upon is portfolio diversification, risk management, and all of that. Those considerations when you're thinking of investing, as a family office, but largely, to early stage companies and early stage ecosystem as well. Let me invite Ashvini Chopra, who's going to moderate this session. Ashvini is a very well-known figure in the industry. He heads a family office practice at Avendus Wealth. Don't need to say much more. Ashvini, welcome. The stage is all yours, sir. Please call the panelists, and we look forward to the conversation.
Soumya, Anand, Aditya, Siddharth, and Vansh. You should be in the middle. Okay, thank you everybody for being here. And I'll try to do justice to what the organizers have put forward to us. Sorry, bear with me. So kicking off, I would like to first touch upon what are the innovative investment products, what are the things, what are the emerging landscape of investing and everything. And for that, I think first we can call on the person who would be of more interest, the angel investor, Vansh. If you could share with us your insights on how you have seen interaction with family offices, what has been your experience of product evolution?
Sure. Thank you so much. So essentially what I can talk about more within the alternative space is about startups. And of course, we saw the rise of family offices liking to invest in startups, unlisted companies ever since, I think, the last 7-8 years. I think the inflection point was the 2020 year. We realized and took a lot of learnings from what went right, what went wrong. I think one trend that we closely observed is families do want to enter at that stage. Especially the next gens of a lot of family offices are looking at it much more seriously. We are trying to innovate a product out there wherein we want to be that network which is not existing currently in India, where we're enabling family offices to look at early stage, early growth companies. What one thing that I picked up from one of our advisors was that I think for a lot of businesses, family offices are coming together, have GVs happening from generation to generation. But when it comes to startup investments, there are no platforms which are trying to democratize it within the family office network. Sure. That's what one product that VC Grid is trying to create.
Sure.
And I think as we talk more in the session, I'll like to cover what are the things that we've realized what families are probably themselves not able to see through what we as professionals and by syndicating so much knowledge base with other families are able to provide.
Thank you, Vansh. Soumya, I would like to ask you, everybody has been talking about family offices. What's this animal called family offices, if you could share? Because you run a multi-family office, so that's...
So just a little bit about what is a family office. I think it tends to get a little confused for many people in terms of what is the role of the family office. I'd like to think that it is serves multiple purposes. It serves purposes around 6 broad areas. The first is around family governance, because you're looking at governance structures that you put in place for a family office. Those are in the form of investment committees, in the form of constitutions, shareholders agreements, educating the next generation, capital allocation. These are the areas in family governance that a family office is expected to take care of. The second area that everyone is familiar with is around investing. And when we look at investing, it's public markets, private markets, real estate, impact investments, passion investments, investing overseas as well. The third area that a family office is supposed to look at is around wealth structuring, which is around having the right investment vehicles, your succession, your trust and estate planning. And this is an important part of what family offices are expected to do. The fourth is really around your day-to-day management in terms of your property management, cybersecurity, accounting, and those are the areas that a family office takes care of as well. The fifth is around managing households. A lot of people don't really add this to what a family office needs to do, but ultimately a family office is a structure which is created to serve the family members, and they don't have needs specifically related to just investing, but a whole bunch of other things as well. And last is around strategic philanthropy. So when you look at a family office, you need to actually cover all these 6 areas.
Thank you. A follow-on question. In the last 20 years, you've been running Waterfield? Or more?
14.
14. So I misestimated. But in the last 14 years, you've been running this. What has been the changes to the product landscape on financing landscape?
So I'm going to touch upon a couple of newer areas that family offices are actually looking at. I think one big shift that we saw in the last 18 months was private credit and the role of private credit in family office portfolios. At the end of the first half of 24, there was about 6 billion which was there, largely shaped by the fact that you had a taxation change in the debt mutual funds. So we saw that private credit, whether it was short duration schemes or venture debt or even performing credit, it suddenly became an interesting aspect to include in portfolios. The second, which we were actually seeing, was on REITs and InvITs. Again, a new asset class that had emerged. Again, a very nice balance to fixed income distribution outside of your traditional fixed income portfolios. The third area that we saw is family offices supporting emerging managers in private equity and venture. And when I say emerging managers, it's really people who have spun off from your larger shops, global shops, who are now setting up their own funds in order to increase the ecosystem. That's a third area. And the fourth, which I will talk about, is just the specialized investment funds, SIFs, which are coming from the 1st of April. Very tax-efficient way in order to look at certain products which were otherwise just in the realms of PMS and AIF.
Thank you. So, Siddharth, being part of the family, business family and running a family office, how do you evaluate these new emerging products or old products? How do you arrive at the asset allocation? What are the risk management strategies that you adopt?
So been part of the family office. I'm 3rd generation at Kothari Group, and we've learned a lot over the last decade. There are a lot of new emerging asset classes in the crypto world. There's venture capital in India has picked up a lot with angel investing, and family offices have really been at the forefront in pushing the movement forward and participating. But there are a lot of ways to avoid kind of pitfalls in this area. And I'd say as a family office, since we're into multiple asset classes, we're generalists, right? I'd say find specialists that are trustworthy and work with them. Add value to them, and you'll get a lot of value back. So, for example, when it came to the startup world, we might not have the most sophisticated, and you know, men lie, women lie, numbers don't. The numbers show that family offices might not have the most sophisticated due diligence teams. But we rely on entities like venture capitalists, for example, to help us through that process, invest with them. And the results are better for it because you can always co-invest at similar terms, and you avoid some of the mistakes that you would have made with a less sophisticated team or less deep technical know-how. So we've really enjoyed fostering relationships with sector domain experts. And that doesn't mean, another big lesson we learned is bigger doesn't always mean healthier. So you know the large funds there, Warren Buffett always says, the fat wallet is the enemy of high returns. There's an inherent issue and challenge with funds with AUMs worth billions of dollars because the wicket is tougher for them. They can't participate in, say, smaller caps, and it's tougher to produce. So you want to find the next Warren Buffetts. So a lot of boutique fund managers out there, some places we found success in, where we've worked with them, and you also learn a lot from them because they'll have more time for each client and they'll have lesser clients. And it's a great kind of, it's of course enriching financially, but it's also really enriching in terms of learning.
And do you look at investing in startups, angel investments and all?
Yes, so a lot of our startups have been through the VCATS ecosystem. We've also LPs in certain funds. We participate in slightly larger companies with funds like Carpe Diem. We're in both their funds. And I feel like it makes sense to spread across to hedge risk. Anyone coming to the startup world, 90% plus startups die, but that doesn't mean you can't make alpha returns here. In fact, you can make multi-bagger returns here by finding that one gem, half of yours you should assume will fail, a few will give back your money or give average returns, and you'll have those 2-3 gems, what's called a dragon in venture capital parlance. A dragon is that one company that returns your entire fund. And how to make sure you participate in that is by spreading across a bunch of names, not being too concentrated in 8 or 10 positions. Instead, we've built over a startup portfolio of about 55 to 60 companies over the last few years. And we're very, very confident in the ones we follow on, invest on, back up on, that it will have the potential to return a bulk, if not all, of our invested amount.
So moving to Aditya. So Aditya, similar questions. Do you have any risk management models or strategies for risk which are there? Do you invest in startups? What is the strategy that your family office follows?
Right. So I think when it comes to investments from whatever liquidity the family would have got after being years in business, we look at it in terms of what kind of diversification is required for that. Because once you are in a business, that's a risk that you have almost taken by being into a business. So there you take a risk when it comes to how you want to expand, what territories you want to go to. But when it comes to the liquidity and the fund that you've got outside it, maybe the risk has to be looked at a little differently, because that's hard-earned money over years that has come in. So definitely diversification, in terms of all assets and looking at tactical allocation after discussing with our advisors, because there are periods in which you would like to change or be prepared for the next run, is where we modulate. But broadly, over the long term, I think risk is in every asset category. I think what earlier used to be the definition of risk is fixed income is less risky and equities are more risky. But we've seen how debt also can be risky if it is not assessed well. So I think risk is everywhere in every asset class, but you can't stay uninvested. You can't not participate in any segment. But what kind of allocation and what kind of tactical change you would like to make over a longer period of time is something that we evaluate, and we keep making moderate changes over a period of time. It's not very big changes that we would like to participate. We discuss, we debate. Sometimes with our advisors, we have a difference of opinion as well in terms of what we consider at this point of time necessary and where we don't think we would like to expose. But yeah, I think risk is best when it is diversified over asset classes. But the expectation is that no investment is risk-free. So there can be surprises in any asset class that you must be prepared for. And I think that we keep in back of our mind while looking at any options that come in the way. But yes, we have to take the plunge. We can't remain uninvested. We have to see, we have to do our research. We have to talk to multiple people. But we have to take the bet also. So yeah, I think the risk we take in business could be much more, while our philosophy has been once you've earned the capital, you look at slightly moderating the risk, you look at diversifying it and not playing a very aggressive call when it comes to the wealth that is created after the business has been encashed. That's how we look at it. Yeah.
So Soumya, moving to you. We in wealth industry actually live off acronyms, I think. REITs, InvITs, you mentioned special investment funds, AIFs, MFs, everything. So does the multiplicity of these products, has it changed the landscape in risk management strategies for family offices that you advise?
So I think one of the things that I've seen for most family offices, and this is probably true also for anybody who's creating an investment portfolio, is that people tend to have a lot of products in their portfolio. At the end of the day, if you've got too many products and the concentration of that risk in a particular product is very dispersed, then particularly in equities, you might as well buy the index. What we found with most family offices, or what we've had to do in terms of their perception of risk, is to say, spend time on evaluating the manager, spend time on the underlying product, do the due diligence extremely well, but make sure that you have fairly high conviction when you're going into a particular investment, because that's the only way you're really going to move the needle in terms of your allocation. So there is such a thing as over-diversification, which is not a good idea. And that really does not help you compound or grow your portfolio materially. The second big shift I think that we're seeing is really about just the concept of asset allocation. A lot of people just look at strategic asset allocation and say that, you need to have so much in equities, so much in fixed income, so much in alternatives and so forth. I see that as a shift for family offices where they're really looking at what we call the total portfolio approach, which is really to say that when I have a portfolio, I'm going to do two things. I'm going to have equity and equity-like returns as one part of the portfolio, and then fixed income as the other. And the reason I say this is because at the time of GFC, most of the portfolios were quite spooked by the fixed income part of the portfolio, which they thought would be the safer part of the portfolio. So when you're constructing the portfolio as well, and you have, let's say, fixed income, which is high yield, fixed income, which is distressed assets, you then need to look at that through a very different lens, which is more equity-like. So what we're seeing for family offices is that they're making that distinction between equity and equity-like returns vis-a-vis what is core fixed income. And the other difference is around benchmarking. It's no longer related to just passive benchmarking where I say that, okay, my Nifty 50 is so much and therefore did my portfolio do better than that through a passive benchmarking, but more around what we call inflation plus and an absolute return. So that's a big difference that we're beginning to see.
Thank you. So, Vansh, moving to you, since you run a platform for Angel, how do you select? Does the role of diversification play is it an important factor in suggesting or choosing the stocks that you, or the companies that you propose?
Yeah, so in the VC Grid platform that we are running, our focus is to, I think we all believe as a core principle that I think people who have built businesses, industries, are people who can just the operating acumen and the business acumen of a founder much better than what we as fund managers can at times. So the whole idea is we validate every transaction through the most relevant business family. And once that validation is with us, that's where we take these companies to other family offices as a financial opportunity for them to invest. So I think that interesting model is actually helping us, on one hand, continuing to expand our community. On the other hand, I think family offices are seeing us as their spokes in early stage ecosystem, trying to scout relevant opportunities meaningful to them. So that's the interesting model that we've sort of discovered in last 15, 16 months of starting VC Grid. And thankfully, I think within this span, we've seen some very good outlier outcomes for the ecosystem. We were able to bring in I think we've probably done one of the largest syndication transactions that the ecosystem would have seen. We got a 10 million transaction being syndicated with two families coming together at a concept stage company, which was a testimonial to the fact that if the right early stage deal with the right founder is taken to the right family, the outcomes can be immensely rewarding.
Thank you. Aditya, moving to you. So in traditional investments and the new age investments, cyber currency, NFTs and everything, or overseas investments, how do you look, or how does your family office look at balancing out the new age investments and creating a diversified strategy?
So I think we've been, I would say, slightly more traditional in our thought process and try to see how simplified we can keep rather than experimenting too many things. Ultimately, an investment is an investment, and what needs to be looked at is what are the risks we are taking, what kind of returns are we likely to get, and maybe yes, what kind of exposure are we getting to learn something new. So we are generally more tilted towards the traditional investments, being more India specific. Not that we don't not that we don't explore something outside. I think in the recent past we've seen a lot of options when it comes to using the LRS route and looking outside. But it's something, the most important thing is the comfort at the family level to be able to take that plunge. So it all boils down to what kind of a return over long period we would like to make, at what risk we would like to take. If there is something which is slightly more risky but promises a higher return, we would definitely explore it. But just from the point that we should have our hands and legs in every new idea that comes up, I think we've been slightly more conservative. As it's we take our time, and I think more towards the traditional aspects, that yes, some part of it in the commodities as a hedge, some part of it in equities again combined into private. And yes, private investments is something which was never part of our consideration. Maybe if we look back, maybe 10 years back, or maybe 15 years back, maybe that time we didn't have enough opportunities, platforms to invest. But I think as India has developed and as the financial ecosystem has developed, these trends have emerged, and that was something which none of the family offices like ours can really afford to step out of it. But again, as Soumya rightly said, that over diversification within that also sometimes doesn't make sense, where you look at multiple investments, very small ticket sizes. You really lose the interest in tracking it, and you feel it's an auto process. Then there's no fun around it. So what we believe, we do something, but we then really would like to understand it well. We would like to debate about it. We may make some investment which is keeping us awake slightly in the night in terms of, okay, what could have turned around, what would have made it successful, is it doing well, so that we are keeping ourselves slightly interested in that space. But yeah, beyond that, again, as Soumya said, over diversification is something that we would like to, as a family, keep it a little on the lower end. Yeah.
Thank you.
Thanks.
So Siddharth, moving to you, have you or your family office invested outside India? Do you look at these emerging new places to invest in? What has been your experience, and how do you go about that?
I think it's a great tool most people should look at. We invest about 10 to 15% of our assets abroad. Right now we have exposure to the US and to China. China's worked out well over the last few months. It was a long wait, and we're cutting down the US as we speak right now. But I fully agree India's the best place to invest. We have the best entrepreneurs here, fast growing country, young population, consumption is growing. But that's why the bulk of our assets are here. But why it helps to kind of diversify geographically is, one, it helps with volatility. Not all markets crash at the same time usually. So it gives a smoother line to your curve. And number two, there are also some themes that don't exist here yet, unfortunately. So something like big tech, you got the FANG companies, Facebook, Meta, Google. They have a global audience. We all use, if I do a show of hands here, 99% of the hands will go up as how many people have used Google today or using Apple iPhones. We don't have big tech as a theme in India. And it's not just big tech. You'd be interesting to know even something, the US is really the hub of capitalism, and you know this why? Because there is a company there called Carriage Services where we made about a 4x. It's in the business of funeral services, where here it's done very kind of unorganized manner. No one capitalizes on it. There, a funeral is more like an event. It's like a party where people wear a suit, say arbitraries, and they kind of, you buy the casket. And there's a multi-billion-dollar company made out of that. So I feel like to identify themes that don't exist in India and for geographical hedge, kind of it makes sense to invest a small portion of your capital. Also, it's important to do what you're good at. And if you can identify these themes, you should play them. You know, a monkey does well in the tree, a fish does well in the water. If you switch it around, they both will die. So know your competence. Yeah. And also be realistic about return expectations. So I really appreciate this term, Kunal Shah, from the founder of Snapdeal. He's a shark on Shark Tank as well now, and founder of Titan Capital. He says, forget chasing unicorns, companies worth $1 billion. What are the chances you'll catch that? Find indicorns. And how he defines the indicorn is a company with a 100 crore top line that is profitable. And there's a lot of money to be made there as well.
Interesting. Thank you. Anand, moving to you. You're the one unique person on our panel. So I would like to learn from you what are the kind of legal and operational challenges you are seeing, the emerging regulatory landscape with the special investment funds, the AIF changes. I mean, I'm part of this, and I see that every month last year, I think SEBI had put out a new regulation or an updated regulation. So what is your take on this, and how do family offices navigate across this?
Thank you. So first of all, family offices are not yet regulated. Yes. So you're not seeing a change every month, and hopefully won't. But all the investment vehicles otherwise are through SEBI. And what you said is correct. I think the emergence of various instruments has required SEBI to keep revisiting the drawing board and seeing what more they can do to safeguard investors. Family offices are sophisticated investors, but a lot of people are not. And SEBI's duty, as they say, is the minority shareholder, the small investor, etc. Having said that, I think we are also seeing issues coming up in terms of the trust structures that are being used. Succession is becoming a bigger and bigger challenge in many ways. We were talking earlier about inheritance tax, whether it's going to come. It's been on the anvil, according to some people, for many years. And a lot of investment decisions are driven by taxation. That's a reality. Because there's no point losing so much money. And people are now leaving India, some of them also to places like Dubai to save tax. So there are multiple aspects that need to be looked at. But to answer your question in a more direct way, in my analysis, the way India is going, you have investment advisors today who are regulated. Effectively, what I see is they just ask the client up front, what is your risk portfolio, and that's about it, a risk appetite. My reading is that's going to be more diligently done by a regulator. I don't know who the regulator will be, possibly SEBI. As complaints rise, which is happening, they need a more robust mechanism to understand the reason for the complaint and how to address the complaint. As I said, today it's still very large family holdings that go into this field. But I'm pretty sure family offices are going to start lowering the bar as the number of them increase around the country. And that's where the challenges are going to get more and more. So interesting times. We will see a lot of change in regulation. I've been talking for some time on this issue. If you ask somebody what doing business in India is like, by the time you answer the question, some law has changed somewhere or some regulations changed. Yes. And the other challenge, you can't even find these because there are so many different websites today. To actually identify what applies to you is itself a challenge. So hopefully the government will look at that as well, which will make it easier for many people to navigate a system that they can read, find easily, and then maneuver through.
Yeah, so don't keep the mic yet. So I have a follow-on question to you. So what is the impact you're seeing on Gift City? How do you see that emerging into this landscape? And it's been slow on the take. So do you see anything changing over there? Is it good for inbound investments, outbound investments? What is it?
So they have a regulation for family offices, which is good. Currently, my understanding is it's only being used for inward. It's hardly being used for outward at all. That may change over time as confidence develops. We've already seen a big change from Mauritius, for example, Cyprus to other jurisdictions. I'm not so sure how much the marketing is being done effectively. I got an email last week from them saying, why don't you set up a law office in Gift City? I've not answered it yet. I'm still analyzing what to do. But I think there needs to be a very concentrated push. I mean, we've seen Singapore, for example, Dubai, for example, a very distinct marketing effort putting out there what the advantages are. I'm not seeing that for Gift City as much as I would like to. But over time, my reading is it will develop. There's a need for more such avenues for India, to my mind, given the population and the generational wealth that's happening now.
So, Soumya, are you looking at any interest in the gift city from your clients and other wider public?
So for us, we look at it more in terms of an inbound vehicle in order to attract global capital into India. I think that is the role that at this moment is better defined than the outbound.
And Anand touched upon trusts and all, the usage of trusts. I'm sure Aditya and Siddharth have also used trusts in their family offices. And I think it would be of interest to the general audience. What are 2-3 case studies which you would, or case in points which you would like to say, okay, don't do this or do this kind of structure? Because, I mean, I'm in the same field, but I see a lot of people focused purely on estate duty considerations, or as you mentioned, tax considerations. Is that the right way to go, or what are the other things to look at?
And I think it's a good question, because it's a challenge to actually dissuade people sometimes from creating trusts because they're so enthusiastic about creating a trust. The reality is it's one more entity to administer, to file a tax return on, etc., to hold your meetings, which many people don't do, to keep records, which many people don't do. It will catch up one day with them. But I think the understanding of why a trust is relevant is critical. What is the objective to be achieved? Why are you creating a trust? What kind of trust are you creating? If it's for succession, it's actually a good way to do it. But within that, are you giving a fixed beneficial right to the beneficiaries? Are you giving a discretion to the trustees? And I think a lot of people also don't realize, as per Indian law, if all the beneficiaries are adults, they can ask for dissolution of the trust. And you can't stop that.
26.
It's a court process here. So the intent is, I think, first to be made very clear to people that, okay, you want a trust. And it's our duty as advisors, I think, to ask them the right questions so that they can actually conclude if they need a trust or not. We get asked this every day, pretty much, by someone. And some people just think, I've got a lot of money, therefore I need a trust. Some people think, as you rightly said, inheritance tax is coming, I need a trust. Some others say, oh, before the government takes away everything from me, I need a trust. All good considerations, but that may not be a reason to jump into a trust structure right away. So I think the planning with a clear decision making as to what's the outcome you're trying to achieve is critical.
Thank you. Vansh, since you are in the angel space and a lot of people here might be looking at raising funds from angel networks, would you care to share about a case study where, or 2-3 instances where, how did you evaluate while investing? What made you invest, or what made you say no to some sort of loose guidance, maybe a minute or so?
In early stages, I think a lot of it is about it's very artistically evaluated. Let me put it that way, more than scientifically. Having said that, the aim for any platform is to just reduce the probability of a failure. One of the first steps you can probably take towards that is getting into a framework where you have right advisors, right people judging what the idea is all about. I think I remember 12, 13 years back when I stepped into this ecosystem. That time, I think the jokes on the other side of the table were that whatever looks fanciest, whatever looks filled with jargons, whatever you don't understand, put your money there. I think those days are gone, and that's not the way forward, definitely. And that learning has happened a lot more in last 3-4 years for everyone. I think today going well informed and finding that right balance of diversifying, but also keeping an eye on maximizing your returns. Over diversification will not make you money. So I think that's one. Second, from promoters, as you asked for an advice, I think promoters need to all the time demonstrate their skin in the game, their passion behind the venture, their opportunity cost. Today, that's a more relevant question to be asked if the founder is doing the venture just because the access to capital is there, or if there is a bigger purpose and a bigger opportunity cost towards him taking that plunge. I think this one particular thing I felt has worked a lot when they're trying to raise money from family offices, because I think that's one of the movers and shakers for their decision making. I think those are the two things that I would sort of immediately talk about.
Thank you so much, and thank you for answering all the questions. Since our time's up, do we have time for audience questions, or how do we do it? So if there are any audience questions, we are available to answer.